Welcome back to the show. Dubai-based regional investment bank SHUAA Capital recently released the findings of its latest report on the UAE banking sector entitled UAE Banks Put to the Test. The study, which was based on 8 banks, which when combined amount to 70% of the banking assets in the UAE, showed that while banks in the Gulf country are adequately capitalized, several may require further capital injections in order to meet the UAE Central Bank's regulatory requirements. Here to share the findings of the bank's stress test and take us through the current health of the UAE banking sector is Khatija Haque, VP and economist at SHUAA Capital. Thank you for coming on the show, Khatija. I've just explained that you've conducted a stress test. Now, from what I understand, you identify 4 scenarios. Could you take us through them, please?
Yep, thanks, Nadine. What we wanted to do with this report was to try and quantify the losses that these banks could take on if there was a significant deterioration in the economic environment, and to see whether the banks were able to withstand these losses. So we focused on what we thought would be the riskiest assets in the bank's balance sheets, and we stressed them individually under 4 different scenarios. So the base case scenario is one where we take reasonably conservative assumptions on default rates, but in our worst case scenario we use maximum default rates across our asset classes to try and see what the most negative impact could be on the bank's balance sheets.
Now, in terms of threats, what would you say are the main or the biggest threats on UAE banks' balance sheets?
Well, when we try to identify which assets to actually stress, we focused on 2008 for a number of reasons. 2008 in the UAE was the height of the credit boom, the height of the real estate boom, and there wasn't a huge amount of credit risk checking that was being done in banks before loans were being granted. So with the bulk of new loans in 2008 going to the real estate sector and to personal loans, we felt that those would be particularly at risk. We also looked at banks' exposure to Dubai World and Saad Al Husaybi, and we also took into account the element in their assets called renegotiated loans. These are loans where debtors have already indicated that they cannot continue with the original payment schedule, and they've renegotiated those loans. So we feel that they're slightly riskier than other loans.
In terms of figures, what sort of figures did the stress test reveal when it comes to capital adequacy ratios and Tier 1 capital? How comfortable are UAE banks right now?
We were actually very surprised with the results of the test, because we found that on average the UAE minimum requirements for total capital and for Tier 1 capital were comfortably met in our base case scenario. In our worst case scenario, even though the central bank's requirements were not met, the international minimums that were recommended in Basel II were still, this UAE central banks were well within those regulatory minimums. So overall the results were much better than we had anticipated. Obviously within the different scenarios there are individual banks that would need additional capital at each of those different scenarios.
If we look at lending, that's a big concern for everyone here. Obviously we're seeing banks still somewhat reluctant to lend, especially to the private sector. Is that a question of public being labelled or viewed as safer? And what will it take for banks to restart lending, and when might we see that happen?
That's a very pertinent question. I mean, there are a couple of reasons why bank lending has slowed down as much as it has. One is that the funding is not as readily available as it has been in the past. Bank deposits have grown pretty slowly, and obviously access to capital markets is probably not as easy as it was a few years ago. As well as perhaps a little bit of difficulty on funding side, we also have banks being more risk averse. We actually think that they're a little bit reluctant to lend because they may be taking into account potential future losses down the line. And so yes, they have been a little bit more choosy in deciding who they're going to lend to, and we have seen that the public sector has benefited from that. We've seen public sector credit growing a lot quicker than private sector credit growth over the last 12 months. In terms of what time frame we see for recovery in credit, that very much depends on how quickly the banks feel more comfortable, and we actually think that there are some measures that could be taken to encourage banks to resume lending, and that's another aspect that we focused on in our report.
You just mentioned potential future losses down the line, so does that mean that you expect banks in the UAE to continue booking provisions going forward?
We think, I mean, in all likelihood, it's an ongoing process. So yes, for example, the Dubai World negotiations haven't actually been finalized yet. Once that has been signed, then the banks will need to take provisions on their exposures, and that's something that's likely still to come up in some banks' cases.
What sort of growth are we seeing in terms of loan growth year on year?
Loan growth has been very, very weak in the UAE. The latest data that we have for total private sector credit is for April, and the year-on-year growth was just 1%, and that's compared to well over 50% at the peak of credit growth in 2008. So it's been a dramatic slowdown. In the other GCC countries, we've also seen a slowdown in credit growth. But that has already started to recover in, for example, Saudi Arabia and Qatar, whereas the UAE seems to be lagging a little bit.
Let's look at potential solutions. We've already seen the UAE authorities step in several times to either help UAE banks clean up their balance sheets or recapitalize when needed. What are some of the measures you would think would be adequate and timely, not just for now, but on the long run as well?
Well, the authorities did take significant steps at the height of the financial crisis to ensure that the banks were well capitalized and they could actually get through that crisis reasonably well. But looking at the results of our stress test, we mentioned that some banks would, under certain scenarios, need some additional capital. One way to tackle that is actually to remove the risky assets from the bank's balance sheets and put them in a separate entity, replace them with lower risk government securities, for example. That would be one way of strengthening the bank's balance sheets, allowing them to access funding a little bit easier and encouraging them to resume lending to businesses and households.
Well, mentioning that, you do look at two sort of approaches that could help formulate a solution. One is the Spanish, one is the Irish. Could you take us through those and maybe tell us which would be more applicable to the situation here?
Yep, we looked at what different countries have done in the course of the last year to try and encourage their banks to start lending again. Of course, this problem is not unique to the UAE.
Absolutely.
Banks around the world have faced similar issues in terms of their balance sheets. We looked at Spain and Ireland because those are economies where the banking systems were particularly exposed to the real estate sector. Not just on mortgages and households, but actually developers and builders as well. So there is quite a parallel with the UAE. Both those countries took slightly different approaches. In general, the Spanish seem to have focused on stricter provisioning criteria for the banks, and also encouraging them to restructure and merge with bigger banks to strengthen their balance sheets. Of course, it would have an impact on earnings in the short term and on banks' profitability in the short term if provisioning requirements were made a lot stricter. So that is something that needs to be considered. The Irish have used a slightly different approach. They have recapitalized the banks that needed the capital at the beginning of the crisis. But they've also gone the route of creating a bad bank, so to speak, where they've removed the real estate assets and put it in a separate government entity and then replace them with government securities.
And so what you think is the most suitable is one that's more Irish?
I think in the UAE's context, it's worth considering what the Irish have done, particularly as the UAE's fiscal situation is a lot stronger than that of Ireland and many European states. At the same time that the European states were trying to get their banks to start lending again, they were also tackling big budget deficits, which fortunately for the UAE is not such a big issue. So in that context, it's something that's worth considering. Although I wouldn't rule out stricter provisioning requirements either. It's possible that a combination of those two approaches might be best suitable for the context that we're in at the moment.
Khatija, in terms of recurring themes, we hear of transparency, good governance, improved regulatory framework within the financial system. Are these things being put in place, and are they yielding results at this point?
Definite steps have been made to try and tackle the structural issues that investors have said are dragging down the UAE's growth. For example, if we look at the transparency issues around Dubai World, for example, when the announcement was made that there would be a request for a standstill, the markets reacted very negatively because there simply wasn't a lot of information in that initial announcement. But lessons have been learned when the initial proposal for the debt restructuring was released in March, there was a lot more detailed information. There was enough for the market to digest and to understand what was being proposed, and the markets reacted very positively to that. So, absolutely things are improving and there are measures being taken to tackle some of these issues, but there is still a lot of work that could be done that would improve the situation even further.
Let's talk about confidence. I know that at SHUAA Capital is something you actually monitor. How much would you say the uncertainty factor is weighing on confidence and on this recovery?
Uncertainty is certainly an element, and it's what we've tried to tackle with this report. We've actually tried to quantify the potential losses that the banks could face if the economy deteriorated further. So I think there is still an element of that that's preventing banks from being a little bit looser with the purse strings. And the resolution of the Dubai World Agreement, for example, the final signing of the deal, I think should provide additional clarification on that side. But the more that banks can disclose what their exposure is to Dubai World, for example, that type of information is extremely useful for the market as well. And generally, more information tends to reduce the risk premium because investors are fully aware of what it is that they're trying to quantify and what it is that they're dealing with.
So just to finish off, my last question would be, in order to set the lending wheel back in motion, in a nutshell, what are the main steps that we need to see undertaken here?
Well, if the crisis of confidence is one of the key issues that's holding back lending, then that needs to be addressed. And whether it's boosting confidence by cleaning up the bank's balance sheets, by recapitalizing some of them where it's required, and then following that up with more longer-term structural reforms, better supervision perhaps, greater transparency, better risk processes in the banks as well. Those are all factors that would contribute to an improved market confidence. And then where the government can support the economy by spending more as well and encouraging demand to pick up, that too would obviously have a positive impact on growth going forward.
Thank you very much, Khatija.
Thank you, Nadine.